Homeowners all over the state could be charged a one-time fee to help pay for wildfire insurance claims out of Los Angeles. And it's all part of a last resort tool the California Department of Insurance allows in expensive wildfire disasters. So ABC 10's Becca Habegger has been looking into this. She joins us now in studio to explain what homeowners might face.
Alex, we're talking about the California FAIR Plan. That, of course, is the bare bones, high cost insurer of last resort. Now, at the start of this week, the FAIR Plan estimated its losses from last month's Southern California wildfires at more than $4 billion. FAIR Plan leaders said they were at risk of finding themselves unable to pay all those claims, so they asked for help.
The Southern California wildfires killed at least 29 people and destroyed more than 18,000 homes and other structures. Many people living in these areas were on the California FAIR Plan, the bare bones, high-cost insurer of last resort. The state established the FAIR Plan decades ago as a way to ensure basic fire coverage is available, but no taxpayer money is involved. Rather, all the insurance companies admitted to do business in the state of California pay into the FAIR Plan, and now they're being asked to pay more in the form of a one-time $1 billion assessment spread among all of them. Between the Eaton and Palisades fires, the FAIR Plan says they have received some 4,800 claims so far, with estimated losses of more than $4 billion. The FAIR Plan leaders say they were in danger of being unable to pay all those claims without that $1 billion infusion from private insurance companies. By state regulation, the FAIR Plan is required to ask the California Insurance Commissioner for permission to collect that money, and on Tuesday, Commissioner Ricardo Lara granted it.
There's no tax money. It's funded by the insurance companies.
Los Angeles-based insurance expert Carl Sussman says this one-time assessment will allow the FAIR Plan to pay the deductible on its reinsurance, basically insurance for insurers, and the reinsurance funds will then allow it to pay out the rest of the claims.
So effectively, this is sort of the one and done, if you want to put it that way, as far as the FAIR Plan is concerned with needing funds.
The last time the Department of Insurance allowed the FAIR Plan to pass costs along to private insurers was in the wake of the 1993 Kinaloa fire in Altadena and the Old Topanga fire in Malibu and Topanga. Those affected some of the same areas as this year's fires. But the difference now is the question: could homeowners all over the state also be on the hook? A change in state regulation approved last year allows insurance companies, if assessed up to $1 billion by the FAIR Plan, to ask permission from the insurance commissioner to pass half of that cost on to policyholders. That means all across the state, home and commercial property owners with an insurance policy in the regular market could see a one-time fee to help offset costs of the Southern California wildfires. How much that fee might be is not yet known.
What we take issue with is the insurance commissioner trying to force consumers to bail out insurance companies for those payments.
Carmen Bulber is executive director of Consumer Watchdog.
Homeowners are stuck on the FAIR Plan because the home insurance industry abandoned their neighborhoods. That's why it should be on the insurance industry to pay those bills, not California consumers across the state.
To be clear, we're not there yet. The Department of Insurance says the commissioner just announced he approved the FAIR Plan's $1 billion assessment, so the department has not yet received requests from insurers to pass the cost along to policyholders. Consumer Watchdog says if insurers are eventually allowed to do that, they will challenge it.
Now, we asked for an interview today with the insurance commissioner. He wasn't available, but Becca, in his news release, he did mention one future solution, right? Can you break that down a little bit?
Yeah, Commissioner Lara, as we've been reporting on extensively, has been talking over the last year and a half and spending the last year and a half overhauling California's insurance regulations. Now, he hopes to see the market improve over the coming year because of those regulations. He has long spoken about the need to modernize the FAIR Plan, and part of that includes allowing the FAIR Plan to access lines of credit and catastrophe bonds to help pay claims in worst-case scenarios like we're seeing right now with the LA wildfires. Now, the FAIR Plan currently doesn't have access to that, which in part is why we're seeing this $1 billion assessment on insurers and possibly eventually some of that falling back on homeowners. And now, Alex, Commissioner Lara says there are bills going through the State House right now that would make those changes. And he is, in that news release, saying he's advocating for their passage.
And I do want to mention, tonight we are hearing from also Republican Assembly members in response to the FAIR Plan. Republican leader James Gallagher sent a statement saying, quote, Forcing working families to pay for the failures of California's insurance market is not a real solution. The real fix starts with reducing wildfire risk, clearing excess fuel, improving forest management, and hardening homes. Until the state takes wildfire mitigation seriously, we'll continue to see insurers leave and costs rise for Californians.